Good afternoon, everyone. Happy Valentine's. Thank you so much for taking the time to join today's webinar. It is top of the hour, and I do want to be respectful of everyone's time, so we're going to go ahead and get started. I'm Reneika Lightbourne, and I'm delighted to have the one and only Chantelle Owens with Tax Lien Bootcamp as our featured speaker. And she's going to, today, she's going to share with us why she loves tax lien investing. So Chantelle, thank you once more for joining us today.
Thank you, Reneika. Thanks for having me. I'm super excited to be here and discuss tax liens.
Thank you. So before I turn it over, I just want to give you like a brief overview of self-direction, the steps to get started with us, and of course, just a little history about Advanta and who we are. If you have questions, feel free to type those in the question box. We will allocate some time at the very end to get those answered for you. Also, too, you'll have my contact information, so if you want to do a deeper dive, you can reach out to me thereafter. So again, my name is Reneika Lightbourne. I'm a business development specialist with Advanta since 2019. I'm also an Advanta client prior to joining, so self-direction is something that I actively do. You can visit us at AdvantaIRA.com, or you can give me a call or send me an email if you want to know more about self-directed IRAs and solo 401ks. So just a little housekeeping before we get started. Just know that at Advanta, we don't give any tax, legal, or investment advice. All of the information that we're going to present today is just educational purposes. So as always, we encourage you to consult with your professional teams, do your due diligence before you make any investments. Some quick takeaways, this is the first time you've heard of self-direction. Just know that any IRA or former employer plan qualifies to be self-directed. When it comes to self-direction, you're in control. You choose the investment that works best for you. Today, we're focusing specifically on tax liens and tax certificates. And then, of course, just know that, all of the expenses that's generated, all of the income that's generated from that investment flows back into your IRA. If there's any expenses associated with that investment, like, for instance, property taxes, would be paid out of the IRA. A little history about Advanta and who we are. We've been in business for about 20 years as the leading self-directed IRA administrator in the business. While we don't give any tax, legal, or investment advice, our team is comprised of attorneys and certified IRA service professionals. We have about 10,000 clients across the nation, a little over $2 billion under our administration. If you have cash that's sitting in your account with us, just know it is FDIC insured. And then, of course, for us, we provide our clients that concierge style service where you have a dedicated account manager that's going to be with you for the life of your account with us. And then, of course, our educational platform where we have experts and guest speakers like Chantelle that comes to knowledge share with our audience. In addition to hosting weekly webinars, we also have something called Pitch, Promote, Prosper. It's like similar to like a haves and wants. We encourage you to visit our website, check out our events page. My colleague Alex also has a podcast. All of our webinars are recorded, so this will be uploaded within 24 to 48 hours on our YouTube channel. And then, of course, our blogs as well features just latest industry news. So exactly what is the self-directed IRA? Just very simply, it just means that you as the account owner, you have complete control of your retirement funds. You have complete control over what is it that your IRA invests in. And then, of course, you get to diversify as you build retirement wealth. So today we're focusing on tax liens, but you can use IRA funds to invest in other real estate related assets, whether it's going to be commercial units or multifamily or rentals like fix and flips. You can use IRA funds to invest in precious metals, oil and gas. The list goes on in terms of what's on the table for you. So a question we typically get is, why do people choose to self-direct? You can look to self-direct for many different reasons. I'll just touch on 3 of them. 1, it's a new source of capital for you. So if you have funds that's in an old employer plan or an existing IRA, you can elect to move those funds over to make your next investment. Or if you're a tax lien investor and you understand and tax lien, the Tax Lien Bootcamp teaches their students to do so, you can actually, partner or JV with other people who have funds sitting in retirement accounts and don't know that they can use those funds to invest in alternatives. And then, of course, another reason as to why someone may choose to self-direct is because of the ups and downs in the stock market. Something overseas can be, in fact, impacting the stock market here, whereas with self-direction, specifically with real estate, you get to diversify. And also, again, we know people are always going to need some place to live, and Chantelle can go in further details in terms of, getting a tax lien and possibly ending up with a piece of property. And then, of course, the tax benefits, having the rents, the profits, dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the ones that you're already familiar with. For individuals, as long as you've earned income, you can self-direct a traditional IRA, which is tax-deferred, meaning you get a tax break up front, and then, of course, you pay taxes later once you reach retirement age and you take those funds out. And then, of course, Roth IRA or post-tax or after-tax dollars, you're electing to pay those taxes up front, grow the account over time. For entrepreneurs, business owners, you can, and many real estate investors, particularly like the solo 401k, but you can self-direct a SEP, simple, or solo 401k. Solo 401k have greater flexibility of higher contribution limits, and I'll touch on that shortly. Some lesser accounts that can also be self-directed are educational savings accounts. So if you have, kids or grandkids, you can certainly look to self-direct their ESA and, of course, HSA. As long as you have a high deductible plan to cover medical-related expenses, you can look to self-direct an HSA. And then, of course, any former employer plan, whether it's an old 401k, 403b, or TSP type plan, they can also be self-directed. The key thing to remember is, obviously, with the Roth, distributions are tax-free at retirement as long as you've had that account for 5 years. In terms of the contribution limits, so you can fund your account several different ways, one of which is making an annual cash contribution as long as you have earned income. With traditional and Roth IRA for 2023, if you're under the age of 50, you can put in $6,500. If you're over the age of 50, you can put in $7,500. And then recently with the Secure 2.0, as of this year, if you're starting in 2025, if you're between the ages of 60 and 65, you can contribute an additional $10,000 into a traditional Roth. For SEP IRAs, you get to contribute, it's up to 25% of earned income, so up to $66,000. With the solo 401k, you're contributing twice, contributing as an employee, and then matching as an employer to where you can contribute up to $66,000. For ESAs, you can put in $2,000 per year per child. And then with HSAs, as long as you have a high deductible plan, for an individual, you can put in $3,850. For a family plan, you can put in $7,750. And also, if you're over the age of 55, you have that additional $1,000 catch-up. So you can have multiple accounts, traditional IRAs, Roth IRAs, an HSA, and you can elect to partner those accounts to go out and purchase tax liens. I do want to, I'll probably reference it in a later slide, but I do want to reference checkbook control. I know typically a lot of real estate investors or tax lien investors specifically like the flexibility of what's called checkbook control or LLC IRA. So there's two ways you can invest, directly through the IRA, meaning you tell Advanta to send the funds where it needs to go, or in this case, if you're going through a tax sale auction, you would work with us, obviously in advance to have those cashless checks sent to you, to where if you go to a tax sale auction, you win a bid, you pay those funds, and then of course if there's an overage, a difference, you send it back to Advanta to be deposited into your account. Or another way is indirectly through an LLC. And a lot of tax lien investors specifically like this feature just because you have greater control, you have greater flexibility, to where you would open up your account with us, you would fund your account with us. The money will only sit with us temporarily until you set up a brand new LLC that's owned by your retirement account, but you get to act as the manager. As the manager, you will have the authority to write a check, pay a bill, sign a contract. You'll also draft an operating agreement document that's going to show that your IRA is the actual owner of this LLC. That lets the IRS know when this LLC goes out and buy a tax lien, don't come after you personally to tax you. It's owned by your tax-sheltered retirement account. Advanta, as the administrator, as the custodian for your account, signs that operating agreement document. Again, you're always in control. No money leave your account until you say it does. Advanta will then issue a check in the name of that LLC that you just opened up, that's owned by your retirement account, give you that check. You get to go to whichever bank you prefer to bank with, open up a checking account for that LLC. Again, you have the authority to do that because you're the manager. deposit those funds, and now you literally have checkbook control over your retirement funds. So when you're ready to go to a tax sale auction, instead of reaching out to Advanta to send cashier's check in advance, you literally can go to the tax sale. When you win a bid, you can write a check for the exact dollar amount, or in this case, get a cashier's check from the bank. And then, of course, moving forward, if the person redeems, the interest payment goes back into that LLC's bank account. If there's any expenses associated with that investment, again, you're paying property taxes, you'll pay it out of that LLC's bank account. The key thing to keep in mind, you don't want to commingle any funds. Any money leaving that LLC bank account is for your retirement investment. Any money coming back in, whether it's a rental property, if you end up with a property or you decide to flip it, the proceeds will flow back into that retirement account. You can get checks, hence checkbook. You can get a debit card, but don't get a credit card. A lot of times when we go to a bank and open up a new account, they would extend credit. Again, you own your retirement account, you control it, yes, but you have to think of your retirement account as its own separate person, its own separate entity, so you can't personally guarantee any loans or lines. If you want to know more about that or need clarity on that, again, you can reach out to me. When you're ready to get started with us, though, the process is pretty straightforward. Step one, fill out the paperwork to get your account open. You can do it electronically if it's an IRA. If you're looking to do a solo 401k, the paperwork is a little bit more lengthier, but we can walk you through that step by step. Step two is funding your account, and you can make a cash contribution. You can transfer from an existing IRA, or you can do a direct rollover from an old employer plan like a 401k or 403b. And then finally, step three is start investing. In this case, if tax lien is your interest, you can then either purchase it directly through the IRA or indirectly through an LLC that's owned by your IRA. And with that, I'll go ahead and turn it over to Chantelle. Just bear with me one moment.
All right. Thank you, Reneika. Again, thanks for having me. Again, I'm excited to be here. Good afternoon to everyone. Thanks for joining us on your lunch breaks. I appreciate that. I'm happy to share this tax lien knowledge with you all. I am Chantelle Owens. I am the CEO and founder of Tax Lien Bootcamp, and I'd love to share my story with you today. So let's get started. So the question I always get asked is, how do I know so much about tax liens? And basically, how did I get started in tax liens? So let's get that right off the bat out the way, so you can get that off your mind, and then we'll jump right into tax liens. So basically, this was my silver lining. It was a property that I owned. I had a mortgage for $139,000, and someone paid $2,100 for that property because it had went into the tax sale. So you can imagine how I felt, but at the same time, I was intrigued, and because I was already invested in real estate, wanted to understand how that could actually happen, and if it was possible that this would be a form of investment that I could also do. So that particular property, it was valued at $150,000 when I purchased it, and I obtained a mortgage for $139,000. It was a 4-bedroom, 2-bath home in Ellenwood, Georgia. And then when the market crashed, the property actually went upside down. So it was actually worth about $100,000 when Tasha came along and purchased it for $2,100. So if you think about that, she walked into a property with $100,000 worth of equity. And at that same time, I still owed $139,000, or maybe slightly less because I had been paying on it for a few years. But, let's say, $130,000 I owed on a property that was worth $100,000. So I actually owed more than what it was worth, and she walked into it with $100,000 worth of equity. So I use this example to show people that tax liens are very different than most forms of real estate, because it is very easy to create a healthy net worth or to walk into a property that has a significant amount of equity and you're paying pennies on the dollar for that particular property. And then once you pay those pennies on the dollar, you actually own that asset free and clear. And so those are some of the things that I want you to keep in mind as we discuss tax liens. So basically what I did is I reverse engineered the process. You know, Tasha had paid $2,100 and I used, you know, that process that she'd done to get that property back. So to redeem that property. And then after that, because I saw, you know, the purchase prices were significantly lower than what I was used to in real estate, you know, I just decided to, you know, gamble on that. And although I didn't have the money at the time, because this was during the real estate market crash, you know, I decided I was going to use my bill money to purchase my first tax lien property. And that's how strongly I, you know, really believed in tax liens. So, and that investment paid off because it has allowed me to leave a legacy, you know, for my children, you know, to be able to leave properties that are free and clear to my children who will be able to also leave that to their children. So that's what can happen with tax liens. Now, all that said, Chantelle, what is a tax lien? Because I know not everybody is familiar with tax liens. So a tax lien, simply put, is if the property taxes aren't paid, the county will file a superior lien in the deed records so that it can be sold for the back taxes. So that's pretty much a basic example of what a tax lien is. How that property is then sold, or the instrument that the actual investor or buyer receives, is where a lot of people have a lot of confusion. So let's talk about that. So the county can sell that deed as a judicial tax deed, which means that the county itself will go through all the legal processes that are necessary so that the end buyer will own that property without having to go through any other legal processes. That is called a judicial tax deed. And it's not the most common, but it does. There are places that will issue a judicial tax deed. Then you have a non-judicial tax deed. This is probably what a lot of people are familiar with. In this particular case, the county will not go through all the legal processes. They will just go through enough to be able to sell the property to you. You won't have to go through as many legal processes as with some other instruments, but you will have to do basically a quiet title in order to have a marketable title with this particular type of instrument. Then you have a redeemable tax deed. Now, with this particular type of tax deed, you're going to be able to purchase the tax deed, but there's going to be a period of time that the homeowner can come back and redeem that tax deed. So then in this case, they would pay you what you paid at auction plus whatever interest rate is prescribed by that particular state. And this is the exact example that I showed you in my case, where the lady purchased the property for $2,100. And because it was a redeemable deed state, I was able to pay her money back, the $2,100 plus 20% interest, which is the interest rate deemed by law here in Georgia. Now, with the previous two that I mentioned, the judicial tax deed and the non-judicial tax deed, those don't have a redemption period. So if you purchase a judicial tax deed or a non-judicial tax deed, the homeowner is not going to be able to come back and redeem. Once you get that deed, those properties are yours. It's just with the non-judicial tax deed, you are going to have to do a quiet title. So then you have tax lien certificates. So a tax lien certificate is not like the other three in that the county is not giving you a deed. It's a certificate. And that certificate is going to basically allow you to be entitled to receive interest on your money. And so in some counties or in some states and within some counties, that certificate can later be converted to a deed, or they have other processes in which it could later become a deed. But initially, if you buy a tax lien certificate, you are not entitled to any property rights. You're basically entitled to interest. Whereas with the judicial tax deed, the non-judicial tax deed, and the redeemable tax deed, you could end up with the property. And then with the redeemable tax deed and the tax lien certificate, you're going to end up with interest. And then there are some later steps that could be taken, depending on the state, to actually receive the property. So of these four, the highest ownership, immediate ownership, is going to be the judicial tax deed. And the lowest is going to be the tax lien certificate, because you're not entitled to any ownership. And then of the four, the highest in terms of being able to expect your interest to be returned to you is going to be the tax lien certificate. And I say this because some people who invest in tax liens want the property, and some people who invest in tax liens want the interest. And that second one is sometimes a new concept to people. They don't quite take into consideration that, oh, I can use this as a way to, especially when you have a retirement account, is another way to grow that retirement account outside of just acquiring the property. All right, so why invest in tax liens? Pretty much because tax liens have a high rate of return, or you get a property that typically is going to have higher equity than most other forms of investment. So just to give you an example, in Texas, you can earn 25%. In Georgia, you can earn 20% that first year, but in Georgia, you can also earn an additional 10% each additional year. So in essence, if a person goes that full year without redeeming, and it goes into the next year, so let's say day 366, you can actually earn a 30% interest. In Arizona, 24%, in Illinois, 18% per year, and it's a 2-year redemption period, so 36% really. And these are high interest, this is a high yield investment if you think about it. And these rates are state mandated rates, right? So it's not like the stock market where this can change, or this is not, in some states, they do have interest rates that are based on the Fed rate, but these particular ones that I've outlined are not based on the Fed rate. So these rates are going to actually stay the same. But just imagine that, being able to, what other investment is going to give you a 25, 30% return. So that's why people invest in tax liens. So, just giving you a quick example, we, have a student who purchased a tax deed property, and purchased that property for $4,500 through an online auction, and the property after repair value was $271,000 at that time. I believe, because this was I believe this was in 2020, if I'm not mistaken. So I believe this property has a way higher value now, because this particular student did keep this property as a rental property. So, all that said, if I can do this, so can you. I'm not going to go through all my history, but I will say, you know, I had lost everything in 2 market crashes by the time I got to tax lien investing. So I lost everything in 2001. There was a market crash, and then again in 2007 or 8, depending on where you were, lost everything again. And then that's how my particular property went into the tax sale. And then from there, you know, just was able to recognize this as a bona fide strategy. And since that time, you know, tax lien investing has helped pull me out of bankruptcy, foreclosure, tremendous amount of debt, and really turn that all around to create a multi-million-dollar portfolio, you know, because the tax lien properties that I purchased, I kept them as rental properties. So just, you know, really to say that if, you know, a person who like me could do it, you know, and certainly at this time I didn't have a 401k or IRA, because by this time I had already been a full-time real estate investor, and that is really all I was doing. And so if, you know, if you're starting with nest egg, then certainly, you know, tax liens is a great and still very viable way to create, you know, financial freedom and wealth. And before I open it up for questions, I'm just going to leave you with 3 steps, you know, because a lot of times people think it's just the vehicle that will get them to where they're trying to go, be it financial independence or wealth, but it's also some intangible things that go along with that. And it took me, you know, 2 market crashes and a lot of headaches to really understand that it's more than just the technical aspect. So I just want to leave you with 3 actionable steps. 1 is invest in your education. So you're already doing that, you're here, but just continue to invest in your education. I, even to this day, still invest in education. So continue to do that. Get a mentor ASAP, because that's going to help you get to where you want to be quicker. And I wish that I had realized that, because I spent a lot of time and headache trying to figure things out on my own with that do-it-myself mentality, and I lost a lot of opportunity costs in the process. And then the last one is to start networking. You know, people really are essential to creating wealth, because, you know, I remember like there were some things that I couldn't figure out in terms of real estate. And it could be just something as simple as, you know, finding a good contractor. And knowing the right people can put that answer in your hand immediately, versus, you know, sometimes years can go by and you don't have the proper answer. So, you know, make sure that you're out here networking to build that. You know, you don't have to be on an island by yourself trying to figure out how to create financial independence and wealth in real estate by yourself, when there's a ton of other people to help you do that as well. And then lastly, just want to share with you that we have a free introductory tax lien bootcamp. It goes a more in depth, because it's a little bit longer than the hour that we have here. We know you're on lunch. We want to respect your time. And so want to invite you out Tuesday, February 28th from 6 to 8 for more in detail talk, you know, about tax lien and tax lien investing. So Reneika, I'm going to hand it over to you, and I want to answer some questions.
Wonderful, great presentation as always, Chantelle. Yes, we do have questions in the question box, so I'll go through that. If you have a question, feel free to go ahead and add it now. Really quickly before I start asking questions, so this webinar is recorded. It's going to be uploaded onto our YouTube channel and also our website within 24 to 48 hours. Also, too, you will get an automatic, because you registered, you'll get an auto email with the link to that application requesting that replay, so you can access that replay. And so, first question, just bear with me. What happens with the mortgage? I'm sorry, it just jumped around. Just bear with me 1 second. So it says, what happens with the mortgage that was previously there? That's the first question.
Right. I love this question because ultimately this is the question that really brings this home for people, because people really don't believe tax liens are real. And I think that is what keeps most people from investing in tax liens. So what happens to the mortgage is this: the tax lien supersedes the mortgage. And that is like the hardest. It's not a hard concept to grasp. It's just a hard concept for most people to believe, that the mortgage company is really going to lose out. And the answer to that is quite simply yes. That's the law. That's the law in 50 states in the United States, is that if the taxes are not paid, the mortgage company will lose out, because the mortgage company also has a responsibility to pay the taxes. So if they don't make sure that the taxes get paid, the county is not just levying the property from the homeowner, they're also levying the property from the mortgage company. So if the mortgage company chooses not to pay, then they also lose out. That the tax lien can foreclose on the mortgage lien. So that's exactly what happens.
Okay, next question. What if there are tenants in the property?
Okay, if there are tenants in the property, that is depending on the state and what type of instrument. So if you're in a tax deed state, which means if you purchase that tax deed, you're going to have physical access to the property right away. You will be able to go and evict that tenant, or, whatever you want to do, you can do. If you want to try to work it out, which I personally don't recommend that, but if that's what you want to do, you can do that, or, you can go ahead and evict the tenant. If it's a redeemable tax deed state, then you're going to have to wait until after you have, the redemption period has expired and you've done your foreclosure process on the owner's right, to redeem, because you also would be foreclosing on that tenant's right to redeem as well, even though they don't technically have a right for the purposes of tax liens. Because they're in the property, they could technically come and redeem the taxes for the owner. Then they would have to work that out with the owner. But all that being said, you would have to wait till after you've done your legal foreclosure process before you could evict that tenant. And then obviously in the tax lien certificate state, there's nothing you can do because you don't have any rights to the property at that point.
Okay, so next question is piggybacking off the first question. Do mortgage companies tend to pay these so they don't lose out?
That's a great question. It just depends on the property. So if it's a higher end property with a newer mortgage where the mortgage company has not it hasn't amortized, then more than likely they're going to come and redeem it. That also depends on how high the bid amount went, right? Because then if it goes too high, at some point it's not worth it for the mortgage company to redeem. So it's a couple factors involved. If it's an older property, a lot of times they won't redeem it because they've already recouped their investment. And then keep in mind, this is something that a lot of people don't, because when we think about real estate investing, we always think about mortgages, but keep in mind, 50% of the properties in the United States don't have a mortgage. So there may not be a mortgage, but if there is, those are kind of the typical cases where they would redeem the property.
Okay, next question. How do you find tax liens per state? Are they listed? When do you and when do you get the list? Or when are they listed?
So most counties do have the list on their website. I will tell you this, they are extremely hard to find. I don't know why counties make it. Well, I do know, because Tax liens are very political, you know, so the number one investor in tax liens are big banks. And so I'm sure that's one of the reasons, but the list is usually hard to find. But by law, the county has to publish that list in their legal organ. So the small little newspaper where you would publish your name change or your incorporation, or if you were publicly serving someone with a divorce, like that particular paper, the tax liens have to also be published in those papers. So you can always find it there. Most of the times you can find it on the county's website. And then, you know, just as a small plug, we do have our own software that, you know, you can find a tax lien list. So
Okay, next question is, can you explain the online auction that the student owned the whole property for $4,500?
yeah, so every online auction is different now, depending on the state. So she particularly purchased that property in a tax deed state. So that was a tax deed online auction. And yes, once she paid her money and received her tax deed, which took about 30 days, she was the owner of that property, and she was able to go in and start, you know, doing her rehab process for $4,500.
Okay, so the next question is, how easy is it to implement tax lien purchases and what kind of training is needed?
Um, Tax lien investing definitely requires some education. I've definitely seen people get into tax lien investing and thought that they were winning, and then found out that they had lost a tremendous amount of money, mostly because there are some legal things that you have to understand. You know, you have to understand what type of instrument you're purchasing, what type of rights that gives you, what you can and cannot do. So it definitely requires, I mean, either you're going to learn, you know, if you invest in your education up front, or you're going to learn on the back end, which, you know, which is kind of what happened to me, because I didn't, at the time when I started investing in tax liens, which was 2009, there weren't any tax lien classes. So I had to, you know, figure it all out. But that being said, my suggestion is definitely, you know, get your education and then implement your strategy when you really have a clear understanding of tax liens.
Okay, so next question is, what are the risk factors of not getting your interest back if investing primarily in tax lien certificates? Once foreclosed, are you guaranteed your interest and investment back?
Now that's a great question. No, you are not guaranteed that your interest back. So you can purchase a tax lien certificate and no one ever comes to redeem it, right? So then you would be stuck with that tax lien certificate. Now, in some states, because every state is different with tax lien certificates, you could potentially convert that tax lien certificate into a tax deed, just simply by going to the county and applying for the deed. Some states have additional auctions, so they would, if nobody came to redeem, they would put that property back into auction as a tax deed. So if someone purchased it as a tax deed, that would pay your tax lien certificate amount plus interest, because that would be the minimum they would start at. Then you would also have the right to purchase the tax deed as well. So every state is a little bit different. But that being said, yes, there is a possible situation where you could purchase a tax lien certificate and it's never redeemed and you can't get a tax deed. And to avoid that, that's where understanding how to do your due diligence and understanding what you're purchasing is going to be significant, right? Because you know, every parcel in the United States has to pay taxes, right? So you may purchase a parcel of swampland, and if you didn't do your due diligence, you wouldn't know that, and everybody else knows that, so they're not going to redeem it. And there's several types of properties that you can purchase that nobody's going to be able to do anything with, so they're not going to come and redeem that property. So.
Okay, next question is there an option of getting exposure to tax liens as part of a fund or consortium if I don't want to manage the property myself?
I can't really answer that question. There probably are funds out there. I don't know of any personally, but a lot of times our students do joint venture with each other. There's always people who have time and not a lot of money. They have the time and know how to, to do the due diligence. And then there's people with money, but they don't have much time. And so we typically, try to make sure that those people get paired up. But, that's pretty much what I can say in reference to that.
Okay, next question is, what are the typical wait times and average in your personal experience? I understand every state is different, but I look to understand from your perspective.
Yeah, every state is different. I have to always say that, because I just don't want people to go into Florida with Georgia information. But that being said, just let's look at Georgia, right? So you purchase a tax deed, a redeemable tax deed, and there's going to be a year mandatory wait that you can't do anything. And then you can start the process to foreclose one day after that. That takes 45 days, right? So now you have the property, but now you have to do two other legal processes. One, which is one other legal process, which is a quiet title. So that could take, let's say average time is 4 to 6 months. So basically you're looking at about, average 18 months before you would be able to do anything with that property. Now, on the other hand, you could go into a state like, let's say Wisconsin, and as soon as you buy the property, you can start rehabbing the property. You can, if you were going to sell it, you could go ahead and do a quiet title, which may take 3 to 6 months or whatever, and but you're still doing whatever you need to do during that time. So every state is different, so I can't really give you an average. I'm just kind of giving you a range of a long time and a shorter time, and there's really everything in between. So you have to narrow in on where you're going to invest, and then you'll have a better idea of that.
Okay, next question is the county obligated to provide this information if you call them to ask them where to find the tax lien list?
Yeah, but they're county workers, so you got to keep that in mind. So, sometimes you get a really nice county worker that's very helpful, and they're going to take the time, out of all the other work that they have to do to, walk you through it. And then obviously some days you're going to get an overworked, underpaid county worker who's like, it's just on the website. They're not going to walk you through step by step. So,
Okay, next question is, do you somehow ensure properties are not encumbered by an EPA judgment against it?
Well, we don't ensure that, but our software does have a way to, look into that. Yeah, so we do look that up, the environmental hazards.
Okay, next question relating to software is there a fee to use the software and training you have?
Well, we only offer the software to our students, and yes, there is a monthly fee to use it. And forgive me, I don't know what the fees are off the top of my head, to be honest with you. But we could give you our information. You can call in if that's something you want to know, but you would have to take our courses in order to have access to our software.
Okay, next question is, who's able to redeem tax lien certificates? The mortgage holder only?
So any person who has a right in that property, so that could be the mortgage company, the homeowner, anybody who has a lien on the property. So if somebody has a mechanic's lien or a credit card lien, they could redeem as well, because they have the right to protect their lien.
Okay, next question is, in Georgia, is there still a legal process that allows you to sell the lien to another entity? In doing so, the right of the redemption is drastically shortened?
No. So how it could be, but the way that question was phrased, I don't want to mislead you. So in Georgia, if I purchase a redeemable tax deed, and the 12-month period starts to tick, and then Reneika comes 6 months later and wants to buy it, there's 6 months left, then yes, she steps into that tax deed with 6 months left. But she can't buy it on day 365 or day one. It's not going to shorten her time frame. She's going to have the same. I'm going to just transfer my time frame to her, basically.
Okay, last two questions, and I think you probably answered these in other throughout other questions, but it says, what are your chances of losing money?
If you don't know what you're doing, it's going to be high. If you do know what you're doing, obviously you're just reducing that risk. I mean, the only way you're going to lose money investing in tax liens is if you purchase a property that is a useless property. No one can use it. That's pretty much, or if you overbid for a property, you're gonna, lose out in the short term. But more than likely in the long term, if you kept the property, you'd come out winning. But those are the ways, pretty much. You have to know what you're purchasing.
Okay, and the final question is, how do you access the property deed record?
You're going to access the property deed record in the county deed house records. Some, depending on the state, some states have online portals in which you can access those records. Not many, but some do.
Okay, and I think that covers all of the questions. Chantelle, thank you so very much. Let me go ahead and make myself the presenter. Just bear with me one. Oops. My apologies, everyone. Thank you so much for taking the time to be with us today. Great questions. Chantelle, you always, knock it out of the park. Any parting words before we disconnect?
Just my pleasure. I just want to say, I for some reason, I've been investing in tax liens, and I've been telling people, and I've been teaching, and people just still don't believe that tax liens are real. So I just want to leave you with that parting word that, this is the real deal. And, the select few who decide to get in it typically do well. And I'll just leave you with this example. I've been traveling since October, and it's all because of tax liens. Like, literally, I haven't done anything else but travel. I've just decided to take time off from real estate, teaching, investing. I've just been, traveling, spending time with family, that type of thing. And it's all because I decided to invest in tax liens. And so it's real. And, just stick your baby toe in it and, try it out. And, see if it could be real for you as well. So those are my parting words, Reneika.
Thank you so much. Have a great day, everyone. And again, the recording will be up on our YouTube channel within 24 to 48 hours.
All right. Thank you. Thanks for having me.
You're welcome. Have a great day, everyone.